Alright, hi guys, so welcome to lesson 8. And in this lesson, we're going to put everything you've learned together into a trading plan. I'm going to show you how to create a trading plan, as well as to show you what are the resources that can help you to succeed as a trader, as well as choosing the right stockbroker. So let's begin by looking at writing your trading plan. So on the resource page, you should be able to download the Piranha Profits Forex Trading Plan. And one of the things that you want to do as a routine is every single day before you start trading is to read your plan, to condition your mind to follow your plan. That's the most important thing. And after you've done this for a while, you become part of your subconscious habit. So let me read to you this trading plan, and it says, the following clearly defines my trading plan so that every day I only look for trades based on this plan. Each trade outcome should be considered purely as a certain R multiple, and it's a small sample of the larger statistical process of accumulating R multiples over time. Remember that on a microscopic level, in other words, on a trade-by-trade level, each trade outcome is random and uncertain. You never know which one's going to be a win, which one's going to be a loss, right? However, on a macroscopic level, after doing many trades based on a consistent routine that gives an edge, which is what you've learned, the impulse pullback and impulse pin bar strategy, the aggregate outcome of many R multiples would be positive. So the goal is to define a plan consisting of unambiguous entry, exit, and risk management rules. This plan gives us an edge because of the following. Number one, entry rules have been given to you to sufficiently stringent to stay away from market noise and sufficiently capture price movements incidentally without emphasis on predictions. Remember, we are not here to predict the market or the price on a trade-by-trade basis, but to follow our plan that gives us an edge. Exit rules are defined, right? Your stop loss and your profit target are defined to allow wins to more than cover losses in the long run, so that the win rate is no longer the emphasis. The position sizing method ensures that the risk per trade is a fixed percentage of the existing account balance, allowing the accumulation of R multiples to compound your account over time. Remember, the edge provided by any trading plan must be preserved through psychologically conditioning yourself to the necessary ups and downs that must happen in your account in the trading process, right? Your account can't go up every single day. It's not a straight line, it goes up and down. Undue concerns about short-term fluctuations in your capital, your net liquidation, tend to diminish or eliminate the edge that the plan is supposed to give, because subtle shifts in your trading behavior, where you intervene, you shift your stop loss, you enter without following the rules, all this leads to deviations from the plan and wipes out your statistical edge over time. Okay, so you have to read this every single day to remind yourself to follow the plan objectively. All right, and the next part of the plan is to write down specifically which pairs will you trade, what time frames, when will you look at it, the entry rules. Write it down, because see, I can give you all the entry rules, but unless you write it down yourself and you commit to those rules, you're not going to follow it completely. So I want you to do that right now. So my suggestion is to print out this trading plan on a piece of paper and use a pen and write down your plan. So the first thing to write down would be, which currency pairs will you trade? I need to write it down right now. Right? Go print it and write it down. And for me personally, I trade about over 10 pairs, but it's really up to you. You can define the number of pairs you want to look at. Okay, so I trade. I'll show you later on in my trading platform which are the pairs I trade. Literally, they're most of the major pairs and some of the cross pairs as well. Okay, next, which time frames do you trade? Personally, for me, I only trade the M15 candle, the 15-minute candles. I find they work the best. So if you like to follow my plan, you can just write M15. But we always look at the hourly candle to counter check before executing on the M15 candles. All right. Next, entry rules. Okay. So write down what are your trading hours. Now, it's always best to define your trading hours, and it should be a time when you are free consistently. So you could say, for example, okay, every morning when I wake up, well, depending, I mean, if you've got a full-time job, you may say, okay, I will only look at the market when I get back, say after dinner from 8 p.m. To 11 p.m. for example, okay, or in the afternoon from 1 to 2 p.m. during my lunch. I don't know, whatever it is, right? So define your trading hours, and you know what? If there are certain valid trades that appear outside your trading hours and you miss them, so be it. If it's not part of your plan, it's okay. As long as you consistently stick to those hours which you have committed to, you will find enough trades that will generate the profits you require. Okay, next. You should also have a rule where you write down how many open positions would you allow yourself. Okay, and again, commit and be consistent. To me, oftentimes there's no right or wrong rule all the time. It's about being consistent with a rule and sticking to it. Okay, so personally, I do not have more than 2 open positions at any one time. So it's up to you. You may say I only want to have 1 open position, that's fine, or 2 maximum is my suggestion. What's the maximum number of trades that you want to do per day? Again, my average is about 3. I do not take more than 3 trades a day because you do not want to overtrade. You want to limit yourself. And normally what happens is that if I have 3 trades which are, especially 3 trades that are 3 losers in a day, I stop for the day. I don't trade anymore. Why? Because I like to break that so-called negative momentum. All right, because when you start to have 3 losses in a row, you start to get emotional, and very often the next trade will be an emotional trade. So you always want to cut yourself off the moment you feel, hey, I'm getting emotional, I'm going to revenge trading, I need to make it back. Boom, you got to get off the market. You can't trade when you're emotional. And to some people, if they get 2 losses in a row, they get emotional. So if you feel that you're like that, you know what? Do not take more than 2 trades a day. Okay, if you feel that 1 loss and you get emotional, boom, that's it. Trade the next day. So it's really up to you. Yeah. So my suggestion is 3 to 4 suggested maximum, but you can also have 1 as well. Next, exit rules. Write down your exit rules. So I already taught you that your exit rule is fixed, stop loss, and profit target. All right. And the stop loss distance should be minimum 8 pips. That's my suggestion. You could change it if you want, but that works well for me. Okay, minimum 8 pips. It could be more than 8 pips depending on where the swing low candle is when you go long and swing high when you're going short. Right, for your profit target, again, write it down. By my suggestion is 1.5 hour. Okay, next, you can also write down, now some people ask me, they say, Adam, if I'm in a trade, it has not hit my stop loss, my profit target, can I exit early? And I say, well, if it's part of your rules that you have predefined, yes. If it's not part of your rules, no. Because you want to, again, be consistent, right? So what are some early exit signals that may cause you to exit early? If you want, you can write it down and follow those rules. So one of my rules is that if a major red news is coming up on forexfactory.com, I will exit the trade before the major impact news. That's when I'll exit early. Okay, so that's one reason. Another thing is I always exit before the weekend. So usually I do not take trades on Friday evenings. If I do, by Friday, like 1 or 2 a.m., because I sleep at 1, 2 a.m., right? I will exit no matter what, because I never hold trades over the weekend. The trouble is that over the weekend, if there's some major news, all right, when the markets open on Monday, there could be a big gap in the price. So we do not want to experience a big gap. Forex prices do not gap during the weekdays, but they could gap over the weekends. I avoid that. So that's when I will exit early as well. Okay, position sizing, write down what's your risk per trade. Again, my suggestion is to start with 1% and eventually graduate to 2% and maximum 3%. So write down where you want to start. So again, depends on your risk threshold, depends on how much capital you have. All right, leave it up to you, but be consistent throughout the trades. Okay. Okay, so write down your trading plan. So that's number 5. Okay, and once you've written it down, you should put it up somewhere near a trading desk. So every time before you trade, read it, condition yourself to follow this plan consistently. All right, so let me talk a bit about my trading routine, right? Now, I'm an entrepreneur. I'm working for myself. I'm a full-time trader. So I pretty much look at the markets the moment I wake up to the time I sleep, right? But like I said, if you have got a day job, then you have to define your trading routine. I'll only look at the market at certain times of the day, right? So what I do is I always keep my computer on, all right, and on my computer I always have my MT4 running together with my broker's trading platform, and on the MT4 I have created all these tabs, right? So Euro USD, Aussie dollar, dollar CAD, dollar franc, New Zealand dollar, pound dollar, euro pound, franc yen. So you can see I look at almost every pair, right? Except the exotic pairs, right? Like I don't look at Singapore dollar or Chinese yen. No, no, no. Euro Aussie, pound yen, dollar yen, Aussie cat, pound Aussie, okay, and pound franc. All right. So let me see how many are those. I haven't even kept count. Like 1, 2, 3, 4, 5, 6, 7, 9, 10, 11, 12, 13. Yeah, I look at about 14 pairs, right? So what I do is now some people ask me, don't you have a life? Do you have to look at this every moment? No, I don't look at it every moment. I look at it maybe once every hour or so, and I take a glance. I may take a glance of 3 minutes, right? And I also have this MT4 installed on my iPhone in an app, right? So you can download an app on your phone that has MT4, and you can actually take a look at it wherever you are. For, like I said, every hour, I may just take a glance for 2 or 3 minutes, right? Now, I only take a closer look if I see there's a potential trade coming up. Okay, for example, when I see, I see the 6 EMA crossing above the 18 EMA, or it's going to cross, or it just crossed, I'll then take a look at it closer to see if there's a pullback, so I can take a trade, or there's a pin bar pattern, right? And if I see that the price is nowhere going to cross or nowhere near what it looks like going to set up, then I don't look at the chart for quite a while, right? So I don't look at it all the time. And the more you look at it, the more experience you get, right? Once you develop experience over a few months, the moment you look at a chart, you can tell if a trade setup is coming up soon, right? If it is not, then you know that it's not coming up soon. You have to look at it, right? So this takes experience. So initially, you may take a bit more time looking at charts. After a while, you will know when to look at it, all right? So for example, I woke up this morning, and it so happened the moment I woke up, I saw this trade. Let me just show it to you. Okay, yeah, over here. So this was this morning. And when I woke up in the morning, I opened my computer and I saw, hey, the 6 crossed above the 18 EMA, all right, and I've got a swing high, right? I got a swing high over there. So I was waiting for a pullback. And one of the things I do is, again, I check that the stars are aligned. Is it on a clear uptrend? Let me just, yeah, it was here. Okay, is it on a clear uptrend? So I say yes. The 6 EMA is above the 18 EMA, above the 50, above the 200. So Aussie dollar 15-minute candles are on a clear uptrend. Okay, what do I do next? I quickly check the H1, the hourly candles. Are the hourly candles on an uptrend? And I can see yes, hourly candles on an uptrend as well. Okay, 6 above 18, 18 above 50, 50 just crossed above 200, clear uptrend. Okay, so I'm ready to take a trade. So let me go. So I go back to 15-minute candles. And where did I take the trade? Let me see. Let me go back. This was this morning. Okay, so I went back there and I saw, okay, the next candle that appeared was a bullish pin. So this is not only an impulse pullback, it's also an impulse pin bar pattern. So it's perfect pattern to take, right? So I'm watching this, and the moment this candle closes, what do? That's right, I get ready to order, right? So I will place my order just above the high of this candle. Okay, 7825. Okay, is where I'll put my buy stop order. Okay, and you got to be really fast. You got to be pretty. So again, you got to practice, right? So I put a buy stop order there. The next candle goes above the high, triggers the buy stop order, and very quickly I got to calculate where's my stop loss. My stop loss is below the low of this pin bar, but must be at least 8 pips away. So you may want to practice a bit of your mental math, right? So 7825. Now, if you need to grab a calculator, let's put 7825 minus 8 pips is 7817. Okay, 7817. So you definitely want to put it below there, which is 7821. Too close, so 7817 is somewhere there, right? So that's my entry price, that's my stop loss. 8 pips is my 1 hour. So my profit target is 8 times 1.5 is 12 pips. So my profit target has been 12 pips above that. 7825 plus 12 is 7837. Okay, so very quickly, 7837. And again, the more you practice, the faster you get at it. The thing is, relax, all right? If you miss a trade, you miss a trade, no big deal, all right? So my profit target is there, entry is there, my stop loss is there. I click new order, right? And I got to use my position sizing calculator, so quickly calculate the position size, and put in the volume, put in your buy stop order, right? Go to pending order, buy stop order, key in your price as usual, 0.7825, 0.7825. All right, my stop loss is 0.7817. Take profit at 0.7837. All right, so once you have that, place the order, orders there. All right, and if it goes up, it triggers and you're in the trade, right? Now, sometimes if you're a bit slow, and you could be when you first start, what could happen, right? Sometimes if you're a bit slow, right? And say you're a bit slow and the candle already popped up above your intended entry price. So now you wanted to buy at 7825, it's now at 7826. What do? Don't chase it. I never chase it. If it goes higher than my intended entry, I don't chase it. Instead, I wait for it to come back down, right? So if the price has moved above my intended entry price, remember, I do not use a buy stop order anymore. A buy stop order means you want to buy higher than the current price, okay? But if it's really moved above my intended price, I want to only buy when it comes back down. So I use a buy limit order, right? So in that case, I'll click on the order and go to pending order and use a buy limit instead, all right? So the buy limit would be 7825. Okay, so the current price is, say, 7826, and my order is at 7825 limit, which means I only buy if it comes back to 7825. Normally it does. I mean, sometimes it may fly off, and if it does, so be it. That's life. But in this case, as you can see, right, the next candle was a red candle, so indeed it retraced back to fill the order. Okay, so no worries, right? And after it filled the order, boom, it went up and hit the profit target. 1, 2, 3, 4, 5. So in 6 candles, you hit the profit target, first winning trade of the day. Okay, and then what happened just now was I took another trade just a few hours ago. You can see this is an impulse pin bar. That's right. You can see the 6 crossing below the 18 here. All right. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. On a 10 candle, I had an impulse pin bar. Can you see the pin bar there? It's a short entry. So my sell order was there. My stop loss is here. Right? And my profit target is somewhere there. Somewhere there. That's right. So right now the trade's working out. It's moving towards my profit target. Hopefully I can hit my profit target in a few candles now. Right? It's still kind of like ding-donging, but currently it's a profitable trade. So you can see it's a clear downtrend, right? With the 618 below 50, 50 below 200. And again, you check with the hourly candles as well, right? So that's what I do. That's my daily routine. And like I said, I take a maximum of 3 trades a day. Sometimes if I take 1 or 2 trades and they're winners, you know, that's it for the day, right? Because remember that I also trade stocks. I swing trade stocks. I've got longer position in the stock market. So Forex is kind of like an additional income source to me. And so that's my basic trading routine. Alright, so the next thing will be trading resources. Yeah, so as part of this package, you can download from the website the Piranha Profits Forex trading tools. So in this Excel workbook, you can see under tabs, there are 3 tabs: position sizing, trading simulation, and the trade journal. So the first thing you can use is the position sizing calculator that I have over here. And again, you could choose to use the ones online as well. Like I mentioned in the earlier lesson, under position sizing, you can go to any website that has a position sizing calculator. This is one of them, myfxbook.com/forex calculator/position size. So you could use this. You also have an app on your phone that you can use. And again, I've mentioned before, you can just key in your account size, say it's 10 grand, you're risking 1%, stop loss 8 pips away, and you're trading euro US dollar, you calculate, boom. So you know exactly how many lots, 1.25 or 125,000 units. Okay, so you could use this calculator if you want online. If you want, you can also use the one I've provided over here. Okay, so to use the ones I provided, what you want to do is you want to, excuse me, you only key in the boxes in white, right? Only enter the boxes in white. The yellow boxes will show you the results. Never ever go to the yellow boxes, because if you type something there, you will change the formula and the calculator will get screwed up, right? So same thing with net liquidation 10 grand, risk per trade 1%. So key this in, key this in. Now the dollar value per pip, what is it? Okay, again, for most US dollar pairs, you can just use $10, right? You want to be precise, go to this website, which I've mentioned before. That's this website over here. For example, if you're trading Euro USD, you use $10, right? Just multiply by 10. This pip value is based on 10,000, right? So for one standard contract is 100,000, you have to multiply by 10. So if you're trading, for example, the dollar yen, all right, it'll be 0.89 times 10, that'll be $89, okay? Which means that if you're trading dollar yen, you have to change this to, sorry, not $89, no, $9, $8.90, sorry, my bad, 890 times 10, so 890, okay? And what you do is you key in your entry price, whatever's your entry price. Say your entry price is 8215, and you only enter without the decimal points, right? Avoid the decimal points, okay? So entry price 8215, stop loss say 8205, and then profit target 8230. Okay, so straight away you can see that the risk to return ratio is 1:5, or 1:1.5, sorry. You're risking 10 pips to make 15 pips, and number of lots would be 1.12, right? So what you want to see is this figure, how many lots to trade, 1.12, okay, based on this formula. So you can use this position sizing calculator. All right, sorry. Yeah, correct. Okay, yeah. And next, always use this trading journal, right? Like I said, trading as a business. In any business, you have your profit and loss statement that you report. So I can tell you that every good trader has a trading journal that they fill in with discipline, right? I can guarantee you that all lousy traders that never make money, they don't have a trading journal. If you use a trading journal, half the better is one, because by writing down your trading journal, it forces you to follow the rules, okay? And if you don't follow the rules, you gotta write a comment, what rules you broke, and the moment you have that rule that you broke, you gotta punish yourself, right? You gotta run 5 kilometers, ask your wife to slap you, or do something that you don't like, all right? So you stick to the rules, okay? So I've given you a few samples of 20 trades a month. Again, you can do more than 20 trades a month. You can simply expand the Excel template. All right, so let me show you how to fill this in. First, say you're trading, now it's September, for example, so put September. Okay, and how many hours did you get? This would be the total of, you can see it's a sum of all the R's here, okay? All the R multiples will sum up to here. You're going to key in the number of trades, right? So let's say you get 3 R out of 5 trades. So your expectancy is 0.6, right? Your expected profit per trade is your total R divided by number of trades. So that means on average, each trade you get 0.6. Make sense? Okay. So how do you fill this in? I've already given you two examples here, the first two examples. So you can then fill in the rest based on these two examples. So the first thing is to put in the entry date and time. Are you going long or short? Key in the currency pair. What's the signal? What's the strategy, right? So it's either going to be the impulse pin bar or the impulse pullback that you've learned in this program, okay? Put in the entry price based on the last 4 decimal places, okay? For a non-yen pair. For a yen pair, you can just put the last 2 decimal places if you want, okay? Or you can put 4 decimal places, or you can put a 4 like 8215. Now, when you key this in, just ensure you key it in without the decimal points, okay? So entry price, stop loss. So you key this in, and automatically this would calculate 10, which is this minus this. And automatically, it will multiply by 1.5 to give you 15. And calculate automatically your target price is 2035. Okay? Once you exit the trade, either at a stop loss or profit target, write down the time of exit and the exit price. So if it's a win, it'll be 1.5. If it's a loss, it'll be -1. So let me give you an example of a loss. So say the next trade is, I don't know, 4th of January 2017. You entered at 3 p.m. and you went long on Aussie dollar. Impulse pullback. And say you entered at, I don't know, I'm just gonna just come up with a number right now. So you entered at 1230. Okay. Stop loss at 1220. Boom. So immediately, when you put these two in, the formulas, you just have to drag it. Okay. Just drag the formulas there. Okay, so you can see if you were to change this to 1210, you can see these changes. Can you see? So this is the formula is there to get this to deduct this, right? So 1220, boom. Immediately this, and this, all three would change based on that formula. Okay, and if you exit at, say, I don't know, you exit at 1530 and you exit at a stop loss, that means you exit at a loss at 1220, boom, you get -1R. Okay, so as you trade, you get 1.5, 1.5, -1, -1, 1.5, and at the end of the month, you have your total, your total R at the end of the month. Okay, so if I were to remove this right now, you can see the total R is 1.5 plus 1.5 minus 1 is 2. 2R, there we go. Okay, so I've given you it here, so you can just fill this in and use this trading journal to keep track of your trades and to comment on whether you have followed the rules. Remember, your job is to just follow the rules, and if you do that, I can guarantee you at the end of the month at least, or 2 months sometimes, you will end up with a positive R multiple. Okay, finally, notice I've also given you this tab that says trading simulation. Okay, and this is the trading simulation sheet where you can kind of like expect what kind of results that you will get as you trade. For example, with an average win rate of, say, 55%, notice that every time you trade, the simulated win rate changes, right? So out of every 100 trades, sometimes you may get a 51%, sometimes you may get 48%, sometimes you may get 57%. So it's random. It's like tossing a coin, right? Like I said before, you toss a coin 100 times, you don't always get 50-50. Although the theoretical win rate is 50%, but you don't always get 50%. You may get more or less, and that's the randomness of life. That's the luck factor, okay? But if you keep doing it, you'll always get somewhere about there, okay? So again, you key in the white boxes, you avoid the yellow ones because the yellow ones have the formulas, do not touch the yellow ones, okay? So when you lose, you always lose 1R, okay? So put 1 here, and you always win 1.5, so put 1.5 there. And assuming you risk 2%, for example, and your starting capital is, I don't know what, 10 grand. So you can see that based on a 58% win rate, in this case, after 100 trades, okay, you can expect that your capital will grow from 10,000 to 23,000, okay, and that is a 138% return in 100 trades, okay. So if you take 20 trades a month, in 5 months, you double your money. If you take 40 trades a month, then in 3 months, you double your money. But having said that, never ever have a quota that says, I gotta take 40 trades a month. No, because if there are no high quality trades, you don't take it. You only take it when you have high quality trades, and you never know when it's gonna come. I can tell you that there are certain months where I only take 8 trades. I only take 8 trades, but all 8 were winners. Okay, and there are certain months I took 20 trades, there are certain months I took 30 trades. So I take the trades as they come. I do not force the trades because it is not linear. All right, take it as it comes. Very important. Okay, and always know that you will have drawdowns. All right, which is like in this case, you can see out of 100 trades, the worst drawdown was minus 4.8, which means we had an average of about 5 losses in a row. And if you're risking 2%, that's about a 10% drawdown. So as your capital grows from 10 grand to 23 grand, you can see these are the drawdowns where your capital will fall over here. Okay, so these are the drawdowns that will happen. So like I said, as you trade, expect that there will be times you get 4 losses in a row, like here, 4 losses in a row. There'll be times you get 4 losses in a row, okay? 4 losses in a row, right? So when you get a few, like look at that, 5 losses in a row, when you get that, it doesn't mean the strategy doesn't work. It just means, hey, it's part of the trading process, because you will also have a time when you get many wins in a row, okay? So on a trade-by-trade basis, I keep saying that the trade outcome is random, right? When you have a loss, don't ask, why did I lose? What happened? I followed the rules, it just happens, okay? So just follow the rules and you'll do well. And I always say that when I start trading, don't think of the outcome of 1 trade or 2 trades. Think of the outcome after 100 trades. Because I can tell you that after 100 trades, you will end up higher than where you are. I guarantee that if you follow the rules, guys. Okay, follow the rules. Okay? Alright, so finally, let's talk about choosing a Forex broker that's right for you. And you've heard me say time and time again that when you are doing day trading and you're just capturing 20 pips or 10 pips, then getting a broker with tight spread is essential, right? If you're a position trader and you're going for 50 pips to 100 pips, then this is not so important. But again, if you're day trading or scalping, this is essential. So first, let's again understand what's the meaning of spread, okay, or we call it slippage. So whenever you're using a broker, you would see that the quotes that they give you would have a bid and an ask price. So let me just write it down here. Okay, so this would be the ask price, and this would be the bid price. So there are always 2 prices that will be moving very fast: the bid and the ask price. Okay, so what's the ask price? Again, the ask price is what people are asking for to sell you their currency. And again, this could be the broker itself selling it to you, or they're offering quotes from liquidity providers. Okay, so what we see here is ask 11139 and bid 11138. Okay, so again, ask are what sellers want to sell at, and bid are what buyers are willing to buy it. Okay, so remember that when you want to buy, when you want to go long, you have to buy from a seller. Okay, so you always buy at the ask price. Okay, and when you sell, you must sell to a buyer, so you sell at the bid price. Okay, so always notice that the ask price is always higher than the bid price by a few pips. Okay, so in this case, you can see that the ask is 111.39 and the bid is 111.38. So in fact, sorry, it's 111.38 and a half. So that's a fractional pip, if you remember, called fractional pip. But in actual fact, what is the spread or the difference between the bid and ask? In this case, it is half a pip. The spread is half a pip. Okay. In this case, you can see Aussie Cat, again, the difference is half a pip. Over here, it's half a pip. Okay. So why is this important? Because the moment you buy, so if you click buy, you're buying at 111.39. Okay. And if you sell immediately, you're selling at a lower price. Okay. So how much are you losing the moment you buy and sell? You're losing half a pip. So the half a pip is known as the spread or the slippage, and it's a cost of entering this position. Similarly, when you exit a position, you are also sacrificing half a pip. Make sense? That's kind of like the cost of entering and exiting. Now, why is this important? Because some brokers, right, their bid and ask spread could be as wide as 2 or 3 pips. Right? That means, for example, you can see the bid is 111.38 and the ask could be 111.41. So in that case, it's a 3 pip spread, right? So what that means is that to enter the position, you are paying 3 pips in commission in a way, okay? When you exit, you pay another 3 pips in commission. So how many pips are you paying as a cost? 6 pips, okay? Now, recall that for most of the time, our stop loss is only 8 pips away or 10 pips away. So out of your risk of 8 pips, another 6 pips you got to pay for commission. That's crazy. You can't make money that way, okay? So it's really important that you use a broker with very small spreads of maximum 1 pip, okay? So the most is you pay 1 pip in cost of entering and exiting the trade, okay? So how do we find these brokers? Now, first of all, you can understand that there are basically 3 kinds of brokers, okay? Market maker brokers, ECN brokers, and STP brokers, right? First, what are market maker brokers, or we call it MM brokers? So these are brokers where they act as the counterparty to your trade. So what that means is that when you buy, who's selling it to you? The broker selling it to you. And when you sell, who's buying it from you? The broker's buying it from you. And so who is quoting the bid and ask prices? The person quoting the prices to you is the broker themselves. Okay? But they will quote prices similar to what the market quotes, but not exactly. Okay? So you're actually trading with the broker and not the actual market. Okay? And normally for market maker brokers, they make their commissions by marking up the spread. So if the normal market spread is 1 pip, they could mark up another 1 or 2 pips. So you see the spread as 3 pips. So the markup is from the broker itself. Okay? Now, this to me, I do not use market maker brokers. Why? Because in a way, when you use a market maker broker, you are trading against the broker. In other words, when you make money, all right, you make $1,000, who lost $1,000? The broker lost $1,000, right? And if you lost $1,000, who makes $1,000? The broker, okay? Now, do you think the broker is stupid? Do you think the broker wants to lose money? No, the broker wants to make money. So it's not in the broker's interest to allow you to profit, okay? Because every time you profit, the broker's losing money. So whenever you use a market maker broker, in a way, it's a conflict of interest, all right? So I don't like that. But there are people who use market maker brokers. Why? Well, because normally the minimum deposit they require is lower. Okay, so normally they target traders who don't have much money. They say, I only have got a few $100 or less, I only got $50. And so they use these brokers because they're cheaper to start an account. But the trouble again with market maker brokers is that you're trading against the brokers, a conflict of interest, and the spreads are wider. So I'm not too, I don't really like that much. Does it make sense? Okay, next. So the next type of brokers you have will be ECN brokers, or electronic communications network brokers. So these brokers what happens is when you place an order, your order is routed directly to the market itself. In other words, you're not trading with the broker, you're trading with the market. And the bid and ask prices that you see are reflected or are reflective of the actual market. They are not quoted by the broker. And for ECN brokers, they do not mark up on the spread. So as a result, the spread is a lot lower, like 0.5 pip spread or 1 pip spread. Okay, so in this case, you may say, okay, Adam, how do the brokers make money if they don't mark on spread? Well, the brokers charge you a fixed commission, right? So normally you pay a fixed commission per lot that you trade. One lot is 100,000, right? And usually for ECN brokers, they require a slightly higher minimum deposit. Now, it used to be a lot higher, but now they've lowered it, so it's a lot more. It's more available to retail brokers. It used to be like 5 or 10 or 20 grand to start, but now you can start with less than 1 grand as well. Okay. Now, what are STP brokers? STP stands for straight through processing, and STP is kind of like a hybrid between market maker and ECN. It's kind of like combining both of them, right? It's a hybrid model between MM and ECN. So STP brokers, what they do is that when you trade with the broker, some of your orders, they route it directly to the market, and some of them, they will trade against you. Okay, so what do you think the broker will do? Well, they see that if you are a trader who keeps losing money, they love you, right? So they'll trade with you because every time you lose, they'll make your money. And if they see that you're a really good trader that keeps making money all the time, they do not dare to trade against you. They will route your order to the market. So there are times when they will trade against you. There are times when they'll route your order to the market. So these are STP brokers, and again, they do mark up a bit on the spread. Right? So personally, for me, I prefer to use ECN brokers for the fact that they've got the lowest spreads, and I pay a fixed commission. That's it. All right, so one of the brokers that I'm now using is Pepperstone, and Pepperstone is actually one of the largest forex brokers in the world, and it's an award-winning broker. It's regulated by the Australian Securities and Investment Commission, or ASIC. Right? Now you can use, again, any broker that you want, but always ensure that the broker you use is regulated by the relevant authority. So for example, if it's a US broker, it should be regulated by the Securities and Exchange Commission, SEC. It's an Australian broker regulated by ASIC, because again, there are many small brokers out there that may charge you really low commissions, but they may not be that safe. Because when you use a broker that's regulated, legally, the broker has segregated client funds. So what that means is when you put your money with the broker, it's in a segregated account. The company can't use that money and can't report it in their balance sheet. So in the event that if the broker goes bust, right, your client funds are safe. So always use a regulated broker. So this broker is an Australian-based broker, and but they do not accept US and Canadian clients. So for that, you can look for another broker like Oanda, which is what I'll be talking about in a while. What I like about Pepperstone is that they use the MT4 platform, and they've got one of the tightest spreads. So they have what we call a razor account, because I guess the spreads are razor thin, and they charge a fixed commission. Their normal commission rate for US dollar account is about $7+ per round trip, which means you buy and you sell at $7+ per lot. Right? But the great news is that many of my students are using this broker, so we have negotiated for a group rate for my students, where my students pay about $5.50 per round trip. So if you're interested to get our group rate, you can email to support@piranhaprofits.com and let them know, and they'll see if they can link you up with that broker. Right? They provide great leverage of 1:500, but do note that if you are from the UK or European Union, the EU has imposed limitations where you can only trade a leverage of 1:30. So because of that, I tell most of my EU and UK students that you can't get that much leverage, so it could be better that you trade on a higher time frame, like the H1 time frame, and then confirm with H4. You can be just as profitable as well. Yeah. At the same time, instead of risking 2 or 3% per trade, you may be able to risk only 1% or 1.5% per trade. So just bear that in mind. Minimum deposit for most forex brokers start as low as $200, and you can nowadays fund with credit card, PayPal, telegraphic transfer. There are many ways to fund the account. For US clients, you can use Oanda. Now, I personally have never used Oanda, but I've heard good things about them, so you may consider Oanda. The only trouble is that they are market maker broker. I couldn't find any ECN brokers available for US clients. I couldn't find any. If you can find one, do let me know. I'll love to introduce it to my students, but I couldn't find one. Okay, but Oanda seems the best of the brokers that are being used by US clients based on reviews I've read. And again, both these brokers trade on the MT4 platform, which is the platform I've been showing in my demonstration. They have got relatively tight spreads of 1.3 to 2 pips. Again, I couldn't find anything lower for these brokers, and by 0% commission. So basically, they make money on marking up the spread slightly. Okay, they offer 1 to 50 leverage on major pairs and 1 to 20 leverage on other pairs, if I'm not wrong. Okay, just double check that. And there's no minimum deposit for Oanda. Okay, so you can do your own research. I've never used Oanda before, like I said. I've read about them, so do your own research. If you know someone better, do send me an email, let me know so I can introduce them to my students as well. Now, finally, Interactive Brokers. I also use Interactive Brokers as a secondary broker, okay? And they are a US-based ECN broker. So their commissions are just as low as Halifax, okay? The trouble is for Interactive Brokers, they do not use the MT4 platform, all right? So if you want to trade with Interactive Brokers, you have to use an MT4 platform from a third-party source and then trade with Interactive Brokers. They offer 1:40 leverage for non-US clients. Okay, now here's the thing about Interactive Brokers, right? I know it sounds ridiculous, but you can read about it. It's true, all right? If you're a US client and you want to use Interactive Brokers to get any kind of leverage, you need a minimum of 10 million US dollars. Yes, I didn't say that wrongly. 10 million US dollars. So they are not really open to retail clients. It's more for institutional clients. Okay, but if you've got more than $10 million, you can use Interactive Brokers. Okay. Now, if you're a non-US client, you don't need $10 million US. You just need 10,000 US dollars minimum to start. Okay. So if you don't have 10,000 US dollars to start, then you may consider Halifax as your alternative, only $200 to start. Okay. So these are the various brokers available. Again, if you want to get our student rates for Halifax, which I mentioned earlier, you can send me an email. If you find any other better broker, all right, do let me know as well. I'd love to introduce them to my students. Okay, so with that's lesson 8 on developing a trading plan and trading resources. Adam Khoo over here. You got questions? Please send me an email, and I'm here to ensure that you are successful as a professional forex trader. Thank you very much for listening.